everyone. I will be talking a few minutes here about where we are today, and that will lead into where we are going. So, what we've seen as of right now, mid-year 2020, we kind of looked at what's improving and what's not improving, and basically, jobless claims are on the decline. So it's been a little bit unsteady, and we're not sure with the COVID increase in the Southwest what's going to happen there. It's going to slow things down a little bit, but that's moving in the right direction. The financial markets and the market conditions are good. The markets have stayed strong and right now continue to look like they're going to remain strong. Again, mostly driven by the tech stocks, but however, the market overall is in pretty good shape. Mortgage applications are actually up, which is a good sign. Consumer comfort levels is up, and again, this is all since the middle of COVID, back in the end of the first quarter here. Restaurant and airline bookings are up in the second quarter. Public transportation has increased, and electricity demand is up. The things that aren't looking so good are obviously the COVID case increase that's taking place in places like Arizona, Texas, Florida. So that's something we have to keep an eye on. It's creating an increase in the potential for lockdown, and we've seen some slowing of reopening in those states, and other states are talking about what they're going to do if the COVID cases continue to increase. Same store sales year over year are down and had been trending down, but what's picked up some of that slack has been all the online. Companies like Amazon and Walmart have done, Costco have done very well during this period. Active oil rigs, they are continuing to close those rigs. So energy is one of the biggest downside impacts to the economy, is that the oil is just not being consumed and continues to build surpluses beyond what's needed, driving a lot of volatility in that market. Steel production also has been significantly down. Obviously, we've shut down auto companies and things like that for a while. Those have started back up, but the impact of the steel industry has been pretty significant and not improving. As Dan pointed out before, the speedometers, this is the view, the way it is right now, looking at the financial indicators for July. And you can't see, the last one Dan showed was March, but I'm going to tell you, I'm looking at the March versus the July, so end of first quarter to end of second quarter, and we've got 5 less red speedometers. So there's been significant improvement. When you look at the first line, consumer sentiment was red in March. That has improved, and it's in a cautionary area. The U.S. economic outlook has improved. It was yellow, but the dials moved significantly to the right. On the second line, what's amazing is housing and mortgages. That was actually in the red at the end of March, and that's moved from red to yellow to just getting into the green area. The housing market has stayed resilient. There's still high demand for housing with little availability, which keeps prices up. Interest rates are low, so mortgages, new mortgages are on the increase, and refinancing. So those are positives. The labor market was also red in March, and that is now in the yellow. Consumer spending has increased significantly, even though it was in the yellow in March. It's moved farther to the right, closer to the green. On the third row, we've had basically the international economic outlook has improved a little bit, not a lot, but the European, Chinese, and Japanese markets, emerging markets, have all improved since March, so that's a good thing. And corporate profit growth was red in March and now has moved into the yellow category. So the bottom row has not changed a lot. The inflation has been good. Credit demand, because of the government stepping in and the Fed reducing interest rates to zero, have kept the credit demand strong, and there's money available, things like that. So overall, though, we had 10 red indicators in March, and we're only have 5 now moving forward. And we're going to talk a little bit more where we think this is going in the next section. Where we're at again with the market volatility. What this chart is showing is that when you look at the first column, the US stocks, at the end of March, the US S&P 500 was down 19%. It actually dipped lower than that going into April for a little bit, but then rebounded strongly. And we've seen a surge back in the S&P 500 to where at the end of June we were down 3%. The NASDAQ, the next 2 sets of our chart here, the NASDAQ was down almost 14%, the 13.95. But that's where we've seen the biggest rebound is in the tech stock, which is primarily the NASDAQ is made up of tech stocks, which actually closed June at a positive 12.67% for the year. However, the world markets, the emerging markets, those went down significantly and are only back about half of where their lowest point was. So they're still down 10, 11%. Bond market had rallied in the first quarter of this year, up 18%. However, that now, as the stock market has got some footing and is remaining strong, the flight to safety seems to be going away, and there's actually been a 10% drop in the bond market in the second quarter. However, it is still positive for the middle of the year. Gold has seen a big resurgence. It went up in the first quarter and continued to go up in the second quarter. Again, that's relative to the fear factor that is out there. So gold pricing has climbed throughout the year with all the volatility. And finally, the commodities indicators down significant at 23.29% in the first quarter, have not rebounded. So you've got your other metals. Oil is a big part of that, and oil is really getting crushed. So that has not improved as much as everything else has in the first half. So let's talk a little bit about the actual PE ratio, which is the price earnings ratio. This is relative to the US market in whole. A lot of times we show just the S&P, but this is for the total market. The price earnings ratio averages historically around 16 to 17 on this scale on the left side that you can see. And you can see today we're at 29.22. So stocks are really pricey right now, a little bit overvalued, but relative to where interest rates are and what's going on in the bond market long term, it may not be that out of whack, but it is significantly higher than the historical level. Not all the sectors have done as well as the tech market we just talked about. When you're looking at the left side of the chart, you can see that communications and consumer discretionary is actually in the positive category for the first half of this year. Consumer staples, however, is down. Energy is the biggest loser right now, down 31% through just this year. And if you remember back last year, it was actually going down last year. So we're probably down a good 60 to 70% in energy alone over the last couple of years. Financials took a big hit this year, down 20% through halfway through the year. Healthcare maintaining its own, but everything else, industrials are down significantly, still down about 12% year to date. Here again, information technology, the tech stocks are the place that is driving the market, and they're showing an increase of 8.5% year to date over last year, which was a good year. So quite a difference when you look at what happened from energy and tech stocks. There's a huge gap in what's taking place sector by sector. Materials, real estate, and utilities are still down over 5% year to date. And those will probably be a little bit longer to trend up. They're not going to respond as quickly as things like the tech industry or industrials and things like that. Profitability for companies through the first quarter, corporate profits were down about 14, almost 15%. And ended the second quarter, we're assuming we got not quite the final numbers yet, but down about 43%. Again, that shutdown just totally, the business world has taken a huge hit with having to shutter in place and not be operating. What we're estimating, though, is we're estimating about a 12% per quarter increase in corporate profitability, and that's what you can see going through the rest of this year and into next year, where we believe we will see positive corporate profits of around 12% versus this year being everything negative throughout the year. Earnings estimates, now this is for 2021. These are those same sectors we were talking about. When you looked at what it looked like at the end of March, that's the gray bars, and the blue, dark blue bars represent where the latest forecasting is going to be for next year. So again, we use this to help determine proper asset allocation of portfolios. Consumer discretionary spending and types of industries we believe are going to do very well next year. Industrials are going to do very well next year. Financials will recover. Materials will come back a little bit. The S&P should remain strong. However, with it being at a high right now, it's probably going to be less of a overall growth. It'll just be more moderate growth over the next year or two. And you can see the rest of the sectors going down in order. But we expect next year to look pretty good. And that's another reason the market is staying high, because stock prices reflect what investors expect will happen in the future. The American Association of Individual Investors put this quote out in June, and it basically reminds us stock prices are established based on expectations. So what the market is actually doing is looking ahead to next year and believing in a good recovery, a strong recovery, and they're pricing that into the values of these companies today. There's a saying out there, don't fight the Fed. And the Fed has been very responsive